In this week's video, we'll review the latest charts to help us answer the question, will the trade war lead to a recession and bear market? We'll kick off the video with a daily chart of the S&P 500 dated November 30th, 2018 at 11:59 a.m. This may seem like a fairly simple chart, but there's an incredible amount of useful information here. As we know, S&P 500 makes a new all-time high on January 26th, 2018. We have a sharp dislocation into the February low. We rally off of that low and eventually print a new all-time closing high in September of this year. Earlier in the year, we had a very painful incident here, and we've recently had another painful incident. And thus far, the lowest low that was made on October 29th is discernibly higher than the lowest low that was made in February. The low that was made in April represents a higher low relative to this low, and this low represents a higher low relative to both the April low and February low. And while Thanksgiving week was incredibly ugly and uncomfortable, last week's intraday low was discernibly higher than the October 29th low. Thus, given what we know as of Friday, November 30th, we have an upward sloping trend channel. Which brings us to our quote that we revisit from time to time from Market Wizards. The second item is something that Ed Sakota taught me. When a market makes a historic high, it is telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that price is at a new high tells you something has changed. This new all-time high here, higher than this new all-time high, told us something. This higher low relative to this low also told us something. There's also a message in this higher low relative to these lows, and there was a message last week when the market made a higher low relative to the October low. The same concepts apply to highs and lows. No matter how many people tell us it doesn't matter that we haven't made a lower low yet or that nothing has changed, the sheer fact that we haven't made lower lows yet tells us something. It tells us that the net aggregate opinion from all market participants related to all subjects on all time frames, bearish conviction thus far has not been strong enough to produce a series of lower lows. We learned something from these higher lows, just as we learned something when bullish conviction is strong enough to exceed this high here in September of this year. And like any other chart, these statements are based on the facts as of November 30th, 2018. If the facts change, we will learn something as well. If this turns into a downward sloping trend channel, and we take out this low, and this low, that will be the market's way of telling us something. So far, it hasn't done that. Right now, we have a higher high and a series of higher lows, which looks more like an uptrend and really doesn't look anything like a long-term downtrend yet. We'll take it day by day. It's also important to note, from this high here in late January of this year to the trading session on Friday, November 30th, market participants have had 308 calendar days to review the fundamentals and make decisions about how they want to be allocated. Thus far, the review of all the fundamental data on all time frames regarding all subjects has not produced a series of lower lows yet, which tells us something. Now, given the fact that market participants have had a very long time to make decisions about how they're allocated, let's see what we can learn from our stock bond charts. In this example, we're using mutual funds since many ETFs aren't around back in 1999. As you can see here, this is SPY and the Vanguard 500 Index Fund. It's two different investments here. You can see they zig and zag together. They are highly correlated. Same can be said for TLT, long-term treasuries in the ETF world, and the Vanguard Long-Term Treasury Fund, or VUSTX. So when we look at this chart here in the ETF world, we're basically looking at SPY divided by TLT. This is a monthly chart. We're using the generic and for illustrative purposes only 5, 10, and 15-month moving averages. The S&P 500 peaks here. We can already see deterioration here, and almost simultaneously with the peak, blue crosses below red. We also know from past videos that in the 2000 case, things get really, really ugly in the market after September 1st. So when we get to September 1st, for the most part, we have a full bore bearish look. Blue, the fastest moving average, has moved from the top to the bottom, and the slopes of all of the moving averages are down. This side here looks significantly different from the left side here. Similar situation in 2008. The S&P 500 peaks in mid to early October. We can see again, almost simultaneously with the major peak in the stock market, blue gets a bearish cross below red. Here, we've got a full bore bearish look after having a full bore bullish look. How does the exact same chart look today? The answer is infinitely better. On November 28th, 2018, we had a full bore bullish look. Blue, the fastest moving averages on top. All of the moving averages have positive slopes here. And if you know your market history, you also know that the S&P 500, and now we're just looking at the S&P 500 in the middle chart. The S&P 500 dropped, had a sharp counter trend rally, and it moved all the way back to 1440 here. So like this period here in September of 2000, things get really, really ugly in the stock market from this point here. So if you exited from this point here, this was still a great time to get out of the stock market. Why? Because from that same point here, the S&P lost an additional 54% in round figures. Thus, if you exited at this point here in May of 2008, it was basically the same as exiting on January 1st, 2007. Therefore, how does our stock bond chart look here right before things got really, really bad? So if we back up now, this chart here, things get really bad in the S&P 500 from here. It's dated May 19th, 2008. If we look at our stock bond chart on the same day, May 19th, 2008, look how much visible deterioration there is on the stock bond chart. From this point here, all the way to this point here, several months, this doesn't look anything, not even remotely close to this. And when we could see this, measure it, and put it in a model, after this, the S&P 500 lost an additional 54%. And keep in mind, as we covered in great detail in a weekly video 2 weeks ago, when the market makes its peak on March 24th, 2000, it would have been very, very easy to say, why would anybody buy bonds in this environment? When the market peaks, when you look in the rear view mirror, you have 14 rate hikes in your short-term memory banks. rates have moved from 3 to 6.5%. And thus, psychologically, at this point here, it's not that discernibly different from how you might feel today about buying bonds. The same argument could have been made when the S&P 500 peaked here in October of 2007. At the end of 2006, looking backwards, in your short-term memory, the last 3 years, nothing but Fed rate hikes, no cuts, and there are no cuts that took place between the end of 2006 and mid-September 2007. Thus, very much like November of 2018, it's very, very easy to make the case where you could say nobody would buy bonds in this environment in 2000, and no one would buy bonds in 2007. And yet, as we've shown numerous times, they were migrating to bonds. We don't have that today. And in fact, going into the G20 meeting, are people loading up on defensive bonds as they were in this case and this case? The answer is no. For the full week, so as of the close on November 30th, 2018, SPY stocks beat long-term treasuries TLT by 4.6% this week. And that really doesn't look anything like this, and it really doesn't look anything like this from a risk aversion perspective. So despite an environment where you would say nobody would be buying bonds with 14 rate hikes in the rearview mirror, no one would be buying bonds with 17 rate hikes in the rearview mirror, it's logical to ask, why were they buying bonds here? Why were they migrating to bonds here? And why aren't they migrating to bonds in the present day? Well, you can make an argument that they were migrating to bonds in the year 2000 and 2007 because they were confident the economy was headed for a recession. Thus, they were confident the Fed would cut rates, and those Fed rate cuts would help push bond prices higher. And they were interested in mitigating losses that they were anticipating in the stock market, and they knew that it was possible they could make money, a lot of money, in bonds. So when they're buying in here and buying in here, they're anticipating rate cuts that came down the road. Was that a good move? Did it mitigate losses in the stock market? And could you have made some money in bonds? In the 2000 to 2002 case, we showed the answer is absolutely positively yes. Bonds up 43%, S&P 500 loses 45%. Despite the 14 rate hikes that are in the rearview mirror here, bond buyers are anticipating a weak economy, and they did indeed get 11 Fed rate cuts in 2001. Did it help with the profit objective? And did it help mitigate losses to migrate to bonds in the 2007 to 2009 case? The answer is yes and yes. And you can make a rational argument or have a logical hypothesis that says the reason why people are not migrating to bonds in a similar manner in the present day is they are not concerned about a recession. They're not anticipating multiple Fed rate cuts as they were in 2007 and the year 2000. And as we've noted before, you can also make an argument that given looking backwards in 2018 that both stocks and bonds have struggled, rather than saying we have a period similar to 2000 or 2007, it's very, very possible we have a period like 1994 where the Fed was raising rates multiple times and investors were getting concerned about the possible impact on the economy. As we noted in mid-November, weakness in stocks and bonds similar in 2018 to 1994. You can also make an argument that the present day is similar to the concerns that investors had in 1994. 1, 2, 3, 4, 5, 6 rate hikes. You get one hike in 1995, And then the Fed takes a big, big break from rate increases. And here's a headline from this week, November 29th, 2018. Powell positions Federal Reserve for pause. Thus, it's within the realm of possibility that just as a pause in terms of raising rates allowed stocks to gain 70% from February 1st of 1995 until this rate hike here in 1997, it's within the realm of possibility that a Fed pause could have a similar bullish effect on equities going forward. Not a prediction or a forecast, that's all to be determined. And as we've covered in past videos, 200-day moving average, ugly in 1994 in December, not discernibly different from the ugly look that we have in late 2018. And once the Fed signaled in late 1994, early 1995, that it might back off the series of rate increases, from this point A here, the S&P 500 rallied for over 5 years and tacked on 236%, telling us to keep an open mind about all outcomes in calendar year 2018. And if you're still skeptical about why anyone would be interested in bonds, you can find a much more detailed analysis of these charts in this video here that was published on November 17th. It's a value line geometric index. Clients and regular viewers know this is a good index to track the performance of the average stock. The average stock entered this box way back in 1982, resistance in 1998, resistance in 2007. The drop in 2009 came back to the same level that we had in 1982. Resistance, resistance, resistance again here, and a bullish breakout. The longer we go sideways, the bigger the move we can expect to get. This is our mother of all breakouts. This is October 8th, 2018. Have we lost this breakout? Does it look like a failed breakout? The answer is not yet. The average stock as of November 29th was up 0.52% for the month. What once was resistance, what once was resistance, what once was resistance may now act as support. This is an ongoing retest. We don't really know the outcome yet, but right now it's very, very difficult to say that the retest has failed. Similar situation, October 8th, global Dow. We don't really know the outcome of this yet. This is November 29th, 2018. Still sitting slightly above this high that was made in 2007. This could take weeks or months to find out whether this is a successful retest or a failed breakout. We'll learn something either way. How is it possible that stocks could continue to rally? NYSE makes a low in 1974 here. You get an 8-year rally off of that low. 2009, 8-year rally off of that low. Fast forward to November 29th, 2018. After the 8-year rally off the 1974 low from this point here, stocks gained an additional 729% over 18 years. So is it possible for stocks to continue to rally? History says yes. And we haven't lost this breakout either. October 8th, 2018, stocks versus bonds quarterly. Resistance, can't even get up here. Resistance, resistance, bullish breakout. We fast forward to November 29th, 2018. Haven't lost this breakout either. Still have this constructive look here with ADX. This is a better look than this look here. And after this, good things happen in the ratio for a long period of time, helping us keep an open mind about better than expected outcomes. The longer a market goes sideways, the bigger the move we can expect to get. The longer a market goes sideways, the bigger the move. The longer a market goes sideways, the bigger the move. Notice the S&P 500 in 1994, a period when the Fed was raising interest rates numerous times and the market was concerned about the rate hikes and the impact on the economy. The longer you go sideways, the bigger the move we can expect to get. How about our 30, 40, and 50 week for illustrative purposes only and generic weekly moving averages? From this point here in calendar year 2000, we have a very tight cluster here. We know we can get big moves out of tight clusters. Soon after this, we have a full-bore bearish look. This is the type of look that we want to avoid in the present day. After we could see this, measure it, and put it in a model, stock market lost an additional 48%. How do the same moving averages look today? The answer is much better. SPY closed November 29th, 2018. So this does not include Friday's gains. SPY has a full-bore bullish look. Blue, the fastest moving averages on top. The slopes of all three of the moving averages are positive. This really doesn't look anything like this, where blue had been falling for quite some time, and we're very, very close to getting bearish moving average crossovers. If we look at the same chart for the S&P 500 as of the close on Friday, November 30th, full-bore bullish look, telling us that the market in the present day is quite a bit healthier from a trend perspective than it was here. And the same thing can be said from this point here in early 2008. After this, after we had a full-bore bearish look, the market lost an additional 52%. Covered this chart back in November of 2016, and we already know the present day looks much, much better. Is it possible that the present day chart morphs into something concerning like this? Absolutely, positively, yes, but it hasn't happened yet. We'll continue to take it day by day. We covered these charts back in October of 2016. If they were helpful then, and they were helpful then, they should be helpful today. This looks a lot more confusing than it is. This is the Ridex inverse NASDAQ 100 mutual fund. So it basically shorts the triple Qs from the ETF world. Obviously, if the 200-day moving average turns up in an instrument that's shorting the stock market or the NASDAQ 100, that's not good for stocks. The 200-day moving average turned up on January 22nd, 2008. After we could see that, measure it, and put it in a model, the S&P lost an additional 49%. The NASDAQ lost an additional 45%. Similar situation. 200-day moving average in the Ridex inverse NASDAQ 100 mutual fund turned up on November 13th, 2000. The NASDAQ lost an additional 62% after we could see this. How does the exact same moving average in the exact same Ridex fund look today? Is it turning up in a concerning manner? The answer is no. This is November 29th. It does not include Friday's gains in the stock market. The same 200-day moving average is making a new low. SPY TLT Monthly, this is October 4th, 2018. Pretty fair to say that MACD here looks a lot more like this constructive look after the bottom in the S&P 500 in March of 2009. And in early October, it really doesn't look anything like this concerning look here when the stock market peaked in October of 2007. If we fast forward to November 29th, we can see we still have a constructive look with MACD. This Doesn't really look anything like this in October of 2007. Notice how red is rolling over here. Red is still up. Black is above red. And if you include Friday's gains for the month, SPY flipped the script and it actually was positive for the month relative to TLT. So instead of having a red line here, we have a black line. How about our simple 100 all the way out to the 290-day generic and for illustrative purposes only moving averages? This is the look here that we want to avoid. This is the look we want to avoid. After we could see all of this deterioration and this deterioration here, the S&P 500 lost an additional 46%, and in this case, an additional 56%. If we fast forward in this case to November 29th, this looks a lot better than this, and this looks a lot better than this. And if we zoom in as of the close on Friday, November 30th, we can see that we don't have any bearish moving average crossovers. Blue, the fastest moving average, is on top as it was here and as it was here. November 30th, 2018 really doesn't look anything like this point here, where blue is all the way down on the bottom. We don't have one moving average crossover on November 30th. Here, blue has migrated all the way down to the bottom. Does this chart look more vulnerable than it did here? Absolutely, positively, yes, but we're not looking for vulnerable. The whole point of using these is we can ask binary questions. Is blue above red? Right now, it's yes. And until it changes to no, we will continue to treat it as a yes. We're open to all outcomes, including this chart morphing into something ugly like this or this. Some quick points from last week's video. Will be moving very, very quickly. You'll remember we covered 13 cases. One of them was November 23rd, 2018. And just as it would have been very, very difficult to comprehend that out of this ugly looking chart pattern here, the next 5 sessions in the S&P 500 would produce a gain of 4.85%, or a gain of 127 points from the close on November 23rd. It also would have been very, very difficult reviewing these other chart patterns to understand that out of the 12 other cases, because there's 12 historical cases, 13 comes by adding in 2018. Out of 10 of these chart patterns, they're all ugly. The average gain was 80%, which helped us keep an open mind despite all of the concerning evidence that we had a week ago. And these cases can still help us keep an open mind from here. 2016 case, from this point A, an ugly setup. 2011 case, from this point A, ugly setup. Really good things happened, and really good things happened between point A and point B. And you'll remember last week we talked about fundamental issues, news cycles, and the headlines. And the basic message in last week's video was it's dangerous to extrapolate ugly charts into the future, and it's dangerous to extrapolate fundamental concerns into the future. Remember, we said, why do ugly chart patterns morph into something like this or this? Well, the answer is relatively simple. Something changes. Something that was bothering the market is addressed or corrected. And it appears that we had a shift or change in the news cycle this week. A week ago, markets very, very concerned about the Fed and interest rates. And it appears that the Fed chairman's comments produced a positive market reaction. Something changed, The really ugly chart pattern from a week ago ended up producing a gain of almost 5% over the next 5 sessions. And here is last week's chart as of the close on November 23rd. Really doesn't look discernibly different than the close on December 8th, 1994. In the 2018 case, if we fast forward 3 trading sessions, the S&P gained 111 points, or 4.23%, between Monday and Wednesday. And in the 1994 case, really good things happened for a long period of time, reinforcing these bullet points. In last week's video, we said it's basically worthwhile to try to remain patient to see what would happen on this retest. We also noted last week that the whole concept of renewed weakness in a retest was not surprising. It was something that we talked about back on October 30th. This is the chart as of Wednesday's close. The same concepts apply. It's still prudent for us to see what happens here. So far, it looks like this is a retest of the low, and it's passing. What happens next week still falls into the to-be-determined category. But let's talk a little bit about what we can learn from this chart. This is the day of the current lowest low, or October 29th. If we look backwards from here, we have a lopsided market. 19 out of the last 21 trading days produced ugly-looking candlesticks. If we fast forward to Wednesday's close, we can see a discernible shift. Instead of having 19 out of 21 ugly candlesticks, or 90% of these candlesticks are ugly, now we have 11 out of 21 looking backwards that are green. 52% of them are favorable here versus less than 10% here, telling us that we're possibly seeing a shift in the net aggregate opinion on this time frame. Here, bearish conviction is dominating relative to bullish conviction. Here, we see some improvement that continues to tell us it's reasonable to try to be patient to see how things shake out in the next few days and weeks. And last week, we noted that thus far, the drawdown that we've seen in 2018 really doesn't look any different from a typical year. And we also showed that the MACD cases and the Wall Street Journal cases, along with the median drawdown, said that what we had last week as of November 21st in this case really didn't look that abnormal. And in all of these cases, patience was rewarded. So nothing has changed heading into the G20 summit. We still have a lot of uncertainty relative to this topic here. And it's extremely important to emphasize, heading into next week, it's dangerous to extrapolate any chart into the future. And it's dangerous to extrapolate any fundamental issue into the future. As we saw with the Fed this week, a shift in the news cycle can turn an ugly-looking chart into a much more constructive chart. And we'll just have to see how things play out relative to the outcomes at the G20 and the market's reaction to those outcomes. There's really no need to make any change to the step-out plan that we've covered generically in these videos and on our blog, Short Takes. We've got a plan for positive outcomes, and we've got a plan for worst-case type outcomes. But all of the charts that we've covered in this video, including the fact that the market hasn't made lower lows in 2018, tell us, given everything that we know today, this looks like a 100% normal and to be expected correction within the context of an existing and ongoing bullish trend. That trend has been on the ropes. We really haven't seen anything yet that says this isn't a normal correction, including economic data that came in on Friday, November 30th, 2018. Chicago Business Barometer surges. New orders hit a 54-month high. Urban Carmel, November 29th. Historically, unemployment claims have started to rise at least 7 months ahead of the next recession. Claims reached a 49-year low in mid-September and have since risen for 2 months. 2 months is not at least 7 months. An asset class behavior that we've covered in this video and we covered in more detail in a Monday short takes post dated November 26 that you can find by Googling this title. Keep in mind, in this post, those charts were as of the close on Friday, November 23rd. And we created those charts on Sunday, November 25th. So we didn't know anything about what was going to happen this week. And the charts in this post told us to try to keep an open mind. The concepts in this post, there's over 60 charts in the post, are still relevant in terms of trying to determine, do the odds favor this being a normal correction or pullback, or do the odds favor it morphing into something much more concerning? Given what we know today, there's nothing that we have in hand right now that says we should give up on the correction within the context of an existing bull market scenario. That may change, but it hasn't changed yet. We've covered these charts numerous times. This is an annual chart with a very, very, very constructive look. This point A here is very, very similar to this point A here, where good things happened in the S&P 500 for 18 years. We covered this chart in July of 2018 when the S&P 500 was only up 2% year to date. As of the close on Friday, November 30th, we're up over 3% year to date, telling us that all of the constructive setups, long-term setups on this chart, given what we know today, are still in play. Given the market's going to be processing a lot of new information relative to the trade war, just as we said a week ago, it's still extremely important for us to head into next week and every week with that flexible, unbiased, and open mind. And just a reminder for clients, if things are volatile next week, we'll be posting comments on an as-needed basis on our Twitter feed. You can find it by Googling this handle here, and we'll supplement that with posts on an as-needed basis on our blog, Short Takes. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.